All right, let's just get right into it. In this explainer, we're decoding the three absolute pillars of corporate finance, the statements that are literally essential for any business's survival. Whether you're budgeting for a massive global corporation or just trying to figure out how a business really operates under the hood, these three reports are everything. We're talking about the income statement, the balance sheet, and the cash flow statement. They each serve a totally different purpose, but together they form this perfect ecosystem of financial data.
You know, there's a reason they say you've got to know the past before predicting the future. It's because historical annual reports are the ultimate blueprint for business planning. You just can't forecast where a company is going if you don't grasp exactly where it's been. These historical documents hand us the exact data we need to make really educated predictions.
So here's our roadmap. First, unpacking the income statement. Second, building the balance sheet. Third, looking at cash flow as our reality check. And finally, connecting all those financial dots.
Starting off with Section 1, unpacking the income statement, basically the corporate scorecard.
This is your classic P&L, and it answers a very basic but absolutely critical question. Did the firm actually create economic value over a specific period? It's the ultimate scorecard telling us if we made a profit or took a loss. Now, the crucial point here is that old saying, you have to spend money to make money. Your top line is your revenue. The inflows from selling goods or services, but you've got to incur costs to deliver those goods, right? So subtract those operational outflows, your expenses, from your inflows, and boom, you get your bottom line, net income. Without that sales revenue, there is 0 point in budgeting the rest of the statement.
And this brilliantly shows the cascading, step-down nature of profitability. You start right at the top with sales, and step by step you strip away the expenses. First, back out the direct cost of goods sold to get your gross profit. Subtract the admin, payroll, and marketing, and you've got EBITDA. Then comes the wear and tear on your assets, depreciation and amortization. Pull out the bank interest, and finally deduct the taxes. Fun fact, Albert Einstein supposedly said the hardest thing in the world to understand is income tax. He might have been right about that, but in accounting, it's just the final hurdle before you hit your true net income.
Moving right along to pillar number 2, building the balance sheet, the financial snapshot.
So unlike the income statement, which covers a whole stretch of time, the balance sheet is entirely static. It's a snapshot frozen on a specific date, like December 31st. It details exactly what the company owns and exactly what it owes at that very second. And it's all built on this unshakable accounting equation: assets equal liabilities plus equity. The left side reflects the resources you control that'll bring future benefits. The right side shows exactly how you paid for them, either by taking on liabilities from outsiders or through equity, the owner's stake in the business. And yes, they absolutely always have to balance. To actually classify these items, we rely heavily on a strict one-year rule. If an asset, like cash or inventory, is going to be used up or realized within 12 months, it's current. If it's heavy machinery that's going to stick around for a decade, it's non-current. And the exact same rule applies to liabilities. A supplier bill due in 30 days, current. A 10-year mortgage, non-current. It's a fantastic way to instantly compare short-term obligations against long-term structure.
Which brings us to Section 3, cash flow, the ultimate reality check between liquidity and profitability.
Just when you think you've got the full picture with the P&L and the balance sheet, we get a major plot twist. Is a profitable business always safe? Honestly, it's incredibly easy to see a positive net income and assume you're golden. But so many firms expose themselves to massive risks because they don't recognize the difference between paper profit and actual physical cash. For a business owner, the only thing worse than a cash flow squeeze is a cash flow squeeze that hits right when the business looks wildly profitable on paper.
Take a look at this slightly terrifying scenario. Imagine you see a fantastic net income of $1 million. Looks great, right? But wait, what if $750,000 of that is completely tied up in overdue receivables because your clients are dragging their feet? That means you only have $250,000 actual cash in the bank. If a $500,000 debt repayment is due next week, this highly profitable company is suddenly insolvent. They literally cannot pay their bills.
And that right there is why we have the cash flow statement. Since survival completely depends on paying your bills when they're due, this statement tracks actual liquidity. It totally ignores paper profits. It focuses exclusively on the cash flowing in and out, pointing out exactly where every single dollar was generated and where it got spent. To keep things organized, we cluster all those cash movements into 3 very strict categories: operating activities, investing activities, and financing activities. Grouping them like this cuts through the noise and shows us exactly how a company is running its day-to-day survival versus its long-term borrowing and investments.
Let's break that down real quick. Operating cash flows, or CFO, are all about your core business operations, like finally collecting that cash from a customer. Investing activities, or CFI, tell us about investments in non-current assets, so buying a new warehouse or selling off old machinery. And CFF, financing activities, is all about the capital structure, taking out a loan, paying out dividends, issuing new stock. It all goes right there. Add those three segments together, and you get your total net cash flow. This is the most vital pulse check of the entire business. It tells everybody, management, investors, you name it, whether the entity actually generated enough physical cash to sustain itself and jump on new opportunities.
Finally, Section 4, Connecting the Financial Dots. Let's look at this interconnected ecosystem. Because all this reporting comes from the exact same operational performance, none of these statements live in isolation. They are deeply linked. When calculating your cash from operations, your absolute starting point is the net income pulled straight from the income statement. But then you adjust it using the short-term working capital stuff from the balance sheet, things like changes in your inventory and receivables. That is exactly how you bridge the gap between paper profit and operating cash.
It's the same story with your investing cash flows. They stem directly from changes in the non-current assets on your balance sheet. If you see your property, plant, and equipment balance jump up from one year to the next, ignoring depreciation, that clearly indicates management just spent vital cash on long-term investments.
And for your financing cash flows, you've got to dig into the equity and non-current liability sections of the balance sheet. If you want to understand capital structure or predict future financing, you look right at those long-term borrowing agreements and dividend policies. It is all completely interconnected.
Which brings us to the ultimate cross-check, the proof that the whole system actually works. Once you calculate your net change in cash on the cash flow statement, you add it to the cash balance from last year's balance sheet, and that total, it has to perfectly reconcile with the cash balance sitting on this year's balance sheet. It's a completely closed loop of financial truth. So as we wrap up this explainer, I really want to leave you with this one thought. Profitability is essentially worthless if you don't have the cash-generating abilities to back it up. Ask yourself, in your own financial planning, are you just chasing scorecard profits, or are you actually maintaining the liquid cash needed to keep the business alive, solvent, and thriving? Something to definitely think about. Thanks for tuning in, and I'll catch you in the next one.